Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Happy New Year, Wolf.
Well, Happy New Year to you, Jim. Thanks for having me back.
Going into the new year, what do you see as the big economic trends for 2022?
Well, the very special trends this year are high inflation, and which will start bringing up interest rates. The inflation thing is something we haven't seen in 4 decades. In fact, it's longer than that. The inflation rate now is the highest it's been since the early 1980s, so 40 years. But back then it was on the way down. Now we are on the way up. So we're really looking at the 1970s here. And hardly anybody's around anymore on Wall Street with experience working in the 1970s, and so we're in the sort of new environment that will cause all kinds of things to happen that we haven't seen in decades. And this inflation won't go away on its own. It'll fluctuate. It'll go up and down, and I don't know where it will go, but it'll bounce around. These are year-over-year numbers, so the index in December will be compared to the index December last year, and so the difference in percentages is what we're throwing around. And then in January's index value will be compared to a year ago. And so, these percentage differences are going to fluctuate somewhat, but they're not going to significantly just go away. Now inflation has moved into services, and it's not related to supply chains anymore. Housing is coming up. Housing costs are coming up. Other services are coming up. So these are unrelated to shipping issues and container issues and plants shutting down in Asia and all this stuff, that started out earlier this year. This is not an issue of supply chains anymore. Now it's just basic inflation based on enormous amounts of fiscal and monetary stimulus globally, and particularly in the United States. And so this won't go away until the central banks crack down on it. And this hasn't really happened in the United States. It's starting to happen in other countries in big ways. And so central banks in other countries have raised. But in the United States, we haven't seen much of that, but this is going to start happening next year. And so short-term interest rates are going to go up next year. Long-term interest rates will be allowed to rise based on the end of QE, so that will happen in March. And then eventually the Fed will start allowing its balance sheet to unwind, so that will put more upward pressure on long-term rates. So we will see fairly gradually increasing long-term rates next year. And that's already come up this year, but they'll go up quite a bit more next year, and short-term rates will also go up. And they will remain negative in real terms, meaning they will remain below the rate of inflation, which causes another layer of distortions. So next year is going to be essentially run by these three major factors. We've got this 4-decade high inflation. We've got interest rates that are gradually going up toward that inflation rate, and we've got real interest rates adjusted for inflation that are below the inflation rate. They're negative. And we haven't been in a situation like that. 4 decades ago, inflation rates were high, but interest rates were very high too. So that's very different now. We have near zero interest rates and at this extraordinary high inflation rate. So this is something we don't have anything to go back to compare what this will do, but this is what we'll have next year, and we'll have to struggle with that, and I think it's going to be a little rough.
How are central banks reacting to inflation so far?
Well, so in the developed markets, so in the United States, Canada, Europe, Japan, and some of the other places, the big central banks have not yet raised interest rates, but they have either reduced QE or have already ended QE. So, for example, the Bank of Japan, the biggest money printer out there for 2 decades, it started tapering QE a year ago, and it ended QE in May. And it hasn't increased its balance sheet since then, and it's cut some of its bond purchases. It's unwound some of its bond purchases, bond holdings. So, this is a case of a major central bank holding its balance sheet flat. The Bank of Canada stopped QE a few months ago, and the ECB has announced that it will cut its QE in half, essentially, by next March. So that's happening in the United States. We've already started tapering. Of course, that's very slow, but the Fed has started that in November, and in December it announced that it would double the speed of the tapering, and it'll be finished by March. And then the interest rate hikes will come. The developing markets, they have much more aggressively gone after this inflation. Inflation is a much bigger threat to their currencies there. And so the Bank of Russia and the Bank of Brazil, they both have jacked up their interest rates by mega amounts. The Bank of Russia is now the only central bank out there where the short-term interest rates, the policy rates, are roughly at the level of the inflation rate, which is around 8.5% in Russia. So they've gotten pretty close to sort of a neutral stance in Russia. And in Brazil, they're chasing inflation. They've got much more inflation there, and the central bank is hiking like crazy, but the inflation keeps getting much faster, much worse. And in other developing markets, they've raised interest rates too, except of course in Turkey, where they're doing the opposite. And so that's been kind of the general reaction. They're trying to front run the Fed. They're trying to make sure that the currencies don't weaken too much against the dollar, because that will make their funding very difficult. And so there's a global move to end the easy money. There's been a dozen central banks that have stepped forward on this now. And so this is happening. The biggest central banks are behind the curve, but they are moving in that direction as well.
What will higher interest rates do to the housing market?
Yeah, this is kind of an interesting thing. Normally, and this time around, this is not normally, but normally what happens is when you have reasonably priced homes and interest rates go up, you have a surge in buying. And as people are trying to lock in the lower mortgage rates that they still have, they see that mortgage rates are going up. They watch central banks acting, and so they try to lock in a mortgage as soon as possible. And so that you have, in the initial phases of rising interest rates, you have a surge in buying, in home buying, and prices tend to go up. And then when mortgage rates reach a certain level, and by a certain level, that just depends on the situation. You can't predict when that happens, but at some point, and that's not very far into that cycle, interest in buying homes fizzles, and activity drops. So we've seen that in 2018 when mortgage rates in the United States, we're talking about the 30-year fixed rate, conforming mortgage rate, got close to 5%. The housing market slowed down dramatically. I mean, in terms of volume, there just weren't a lot of buyers out there, and prices were weakening, and it was just shortly before the Fed changed its mind, but this is what you get typically. Now, this time around, it's very different. We have extraordinarily high home prices. I mean, they have spiked by 20% year over year on average in the United States, and in some markets by over 30%. It's just been ridiculous. So now we've got these extraordinarily high prices. We've got very low mortgage rates, and we're now looking at rising mortgage rates, but who is going to be out there that still wants to buy homes at these extraordinarily high prices? And volume is already not very high in sales volume, in part because there's not a lot of inventory on the market, and in part because prices are so high and not that many people can afford it. So this classic behavior of jumping into the market as you see mortgage rates rise, this may not play out as much as it did last time. And because mortgage rates, they're very low, but they're not low enough to allow people to buy at these very high prices. So you've got this ceiling in the market there, and so we've seen a little bit of that, but not much. I mean, volume is still very low and relatively low, and so yeah, I don't know that we'll get this little surge in buying activity this time around. But one thing we know: when mortgage rates reach that certain level, volume will fizzle. And the market kind of freezes up at that point, and it doesn't really move forward in terms of volume until prices come down. And so there'll be buyers out there, but not at those prices. They're paying higher interest rates on their mortgages, and they need a lower price point, and they're going to just sit there and not buy until they can make it work out. And this happened every time, and that's why interest rates are being pushed up, is to cool all kinds of inflation, including house price inflation, and so that's what higher mortgage rates will eventually do. They will eventually cool down the housing market.
Courtesy of the bond market, could mortgage rates move up higher and faster than expected?
Yeah. So in the United States, the 30-year fixed rate mortgage is tracking roughly the 10-year Treasury yield. So it's higher than that, but it sort of moves in parallel. Not 100%. There's a spread between it, and that spread changes. But it's kind of linked to the 10-year Treasury yield. And in Canada, of course, you have a lot of variable rate mortgages, and they're more linked to short-term interest rates. But just sticking with a scenario here in the United States, with the 30-year fixed rate mortgage, which is our benchmark mortgage, these long-term interest rates, they're not seriously moving up until the Fed stops buying mortgage bonds and Treasury securities. And so that's going to happen in March. And then they'll be allowed to move up a little bit, but the Fed still owns this huge pile of these securities. And so they still won't move up very much until the Fed starts unloading some of its balance sheet by letting securities mature without replacement. And that will allow long-term interest rates to go up quite a bit. And in terms of the Fed action, this is now moving faster than anybody had anticipated a year ago. Every Fed meeting, things get sped up, and so a few months ago there's still going to be no interest rate hike next year. Now there's 3 of them planned. Or suggested, this can go to more interest rate hikes. These are short-term hikes, short-term interest rates. In terms of the long-term interest rates, we're looking at the end of QE, so that's been sped up to March. Then we're looking at the balance sheet unwind. The Fed is already talking about that, so they're preparing the markets for that. And so this is happening a lot faster. Last time when we went through this procedure, it took 5 years. This time it's happening really fast. So we're, relatively speaking, not stretched over 5 years, but over months, really. That's what we're looking at. So I think the balance sheet unwind will begin sometime next year instead of several years down the road. And this will allow long-term interest rates to rise and keep the yield curve steep. So you don't want to push up the short-term rates while locking down the long-term rates through the Fed's balance sheet action. So a central bank would want to let those long-term rates go higher before it starts pushing up the short-term rates. And the Fed is clearly on that trend. It wants to allow long-term rates to go higher in order for the Fed to be able to push up short-term rates. And I think there'll be more short-term interest rate hikes than the 3 that we now see. There'll be higher long-term interest rates across the board. They'll go up faster, and I think this 5-year procedure last time will probably be pushed into less than a year.
What usually happens to real estate prices during periods of significant inflation?
Well, the last time we had significant inflation, that was 40 years ago, and it was coming down. So it was really 50 years ago when the inflation was at this level and going up. And, back then we had much higher mortgage rates. So that pressured the real estate market. And, when interest rates then were pushed up further to bring this inflation under control, real estate took a pretty good hit. And, we had certain sectors get hit really hard. For example, agricultural real estate, farming. There was a bubble going on in that sector back in the late 70s, early 80s. And that bubble blew up magnificently. And it took down a whole bunch of farm lenders. And so banks that specialize in lending on farm property and on agricultural land, and it caused a major problem in the plains and elsewhere. And this was a place that were rising mortgage rates really blew up everything. Suddenly, the farmland didn't make any sense anymore. Those prices and prices plunged, and then the collateral values plunged, and banks became insolvent and were shut down by the FDIC, and there's just this whole chain reaction started. The same kind of thing that we saw during the mortgage crisis in 2008, 2009, and forward. We saw back then when interest rates rose, and so you can't really predict exactly where this is going to hit, but higher mortgage rates make real estate generally more difficult to finance, purchase, and banks are starting to get damaged by declining collateral values. They tighten up the rules and they try to stay above water. And so you get this whole cycle started. So when there's a lot of inflation and interest rates are going up to meet that inflation, then real estate is going to have some troubles. If inflation is allowed to just rage as it does now, and mortgage rates remain low because the central banks force them down, that's financial repression. That's what we've got right now. We've got mortgage rates below the rate of inflation. In that scenario, real estate prices could hold up pretty well. But that scenario is not likely to last very long. The central banks are getting really nervous about this inflation, and so they're starting to crack down. And I don't think that we're going to have negative real mortgage rates for very long as we have now. They're going to be positive, and they're going to be much higher, and they're going to deal. The central banks are going to deal with this inflation by bringing up long-term interest rates. So we're in a scenario we haven't been in my lifetime, really. With these short-term interest rates and this high inflation and the high house prices, and so anybody working on Wall Street that isn't 100 years old probably hasn't seen anything like that. And so I think it's just going to be over the next few years. You're going to see this come to a head, and we'll see the beginnings of that next year.
Well, in 1981, I remember the Canadian government put out savings bonds that paid 21% interest, and I scraped together every penny I could find to buy them because I thought they'll never pay this kind of interest again, and they never have. But
yeah, that was a good purchase. That was one of those once in a lifetime things. If you can buy, people bought 30-year Treasury securities back then too. That turned out to be some of the best investments ever. For 30 years they collected 15-16% interest, coupon interest on these bonds, and that's a great deal.
We'll have more with Wolf Richter right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Wolf Richter. Wolf, what's the latest on the automotive chip shortage?
So this is the end of 2021, and the chip shortage should have been over already, and it's still not over, but it's getting better. So there are still problems like Toyota, which got through the first half of 2021 with flying colors, hit some real rough spots in the summer and the fall, and had to curtail production by large amounts. But it's now kind of back, so it's started to get its supply back in order. The American brands, they ran into real problems earlier this year and then got their supply chain sorted out a little bit better. So now they're starting to get better. They started getting better supply a few months ago, and so production is coming up a little bit from there, and so there will be issues. There will continue, but there will be fewer issues, and production is already coming up a little bit. It will continue to rise. I mean, but the thing is, we're so far behind in production, and inventories are so low that even when production goes back to normal, it won't really catch up. It will just keep the status quo. And to catch up, production would have to go above normal. And I'm not sure we're going to see that. But prices are also so high that I don't think there's a huge amount of demand beyond what's out there now. So, and sales are way down and in terms of unit sales. So, I think for the next few months next year, there will be this kind of, enough demand for the high prices to continue, but production will come up and there will be more supply. And then as this new supply starts showing up, we'll have to see how demand is meeting that supply, and if these currently extraordinarily high prices can continue to fly when there's more supply out there. And I have never seen anything as distorted as the auto market now, so I really don't know where this will end up. But it's hard for me to believe that these high prices can just continue to rise further. At least that would have to level out, I think, in order for when there's more demand showing up and people realize that they can actually choose and shop around a little bit.
Could the new vehicle shortage allow the big automakers to transition to a Tesla style of factory ordering of vehicles by the consumer, where it's delivered to your door, instead of a dealership ordering vehicles where they build up an inventory and you go to a car lot?
Yeah, so in the States, we have the franchise laws, and they regulate how automakers can sell vehicles, and they have to sell through the dealer. Now, Tesla made a special deal with a whole bunch of states, so it's the only automaker that can sell direct in those states, and not all states. I mean, there's some states where Tesla cannot sell cars. So this is kind of a legal thing, and in order for the automaker to sell to the consumer, the automaker has to go through the dealer or through a dealer, and except Tesla. And so this is the environment that they're now looking at. But what customers have always been able to do is go to the dealer, order at the dealer, and then wait for the vehicle to show up. What customers can now do is order on the internet, and have a dealer finalize the sale and deliver the unit. But they still have to go through a dealer. They still have to go there. Now, dealers don't really, if they have inventory in stock, they don't really want to order for their customers. They want to make the sale today. So if they have something that they can sell you today, that's what they want to do, and they want to close the deal today and to deliver the unit and be done with it and get the credit and get the money and move on to the next sale. If they order a unit for you, they don't get the sale, the credit for the sale or the money until the unit is delivered. And that's 2 or 3 or 4 or 8 months later, so they don't really want to delay the sale. Right now that's happening a lot because that's the only way customers can buy a car. They order it and they wait for months to get it. And especially popular trucks. Now on the low end you can't hardly get anything anymore. That's deprioritized. So right now that's working because dealers don't have any inventory, and that's the only way they can sell anything is to order for their customers. But once they do have inventory, the dealers will pressure customers to buy what they have in stock. And that's just how that's done. They want to close the deal today, and they want to send the customer home in a new vehicle. And so that's the counter force here. Customers may be interested in ordering, but you have to wait months to get your vehicle, and so the whole impulse buying goes away. It's something that many customers don't really like to do. They like to put their hands on the car. They like to drive it, test drive it. They want to pack the family in to see, and they want to see the color in the sunlight. And even new vehicles, people generally like to physically touch. And of course, all that's changed now. If we can train consumers enough to where they buy a new vehicle without actually sitting in it beforehand, and if we get dealers to not pressure customers to buy what they have in stock, but get something that they can order, this could be a trend. And automakers would love this. So this is something Ford and everybody has said. They would like to transition to a system where there are fewer vehicles in inventory and more vehicles are purchased through ordering. That would be a lot more efficient. It would be a lot less capital intensive for everybody. Now, the dealer inventories are financed by Ford. Ford will finance through Ford Motor Credit the dealer inventory through a floor plan arrangement. So it's not the dealer necessarily that has to come up with the capital that borrow this money, and the interest rates are very low, but it's the automaker that has to do all that. So automakers would be ecstatic if consumers and dealers could be swayed to a system where a much larger portion of vehicles are ordered than there were before the pandemic. And there's a lot of movements in that direction. If that is taking place, and after a year or two, the trend persists, and more Americans are wanting to order a vehicle rather than buy what's on the lot. Of course, then the real estate the dealers sit on is a little bit extravagant, and you don't need these huge lots with hundreds of cars on them. And there's benefits all around. If you have 600 cars on your lot, that you have to maintain them, you have to clean them periodically. You have a whole team of people that takes care of those cars. So if you could cut that down to, say, 50 cars, just have some sample units, that would be a huge benefit for auto dealers too, if they jump on that program and if they are okay with selling something that they're going to get credit for 3 months down the road. And, it'll be interesting to see. The pandemic has changed a lot of things, and, working from home, those kinds of things, we still don't know if that's permanent or what portion of that is permanent. And we think some portion of it is permanent. And the same thing with ordering vehicles directly from the automaker. I think there's going to be some portion of it that's permanent, that people have gotten used to it and they enjoy it, and it's easy to do. And they're going to have to wait a few months, but no big deal. And so I think there will be at least part of it that's permanent, and then the dealers will have to restructure their operations to make that work.
Wolf, thank you so much for chatting with us, and have a happy and very prosperous New Year.
Thank you, Jim, and Happy New Year to you and all your listeners. Thank you.
My guest has been Wolf Richter, publisher of WolfStreet.com. He was speaking to us from San Francisco. If you have any questions for Wolf, we'll ask that question for you if you send it to info@HouseStreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.